Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. You can watch these podcasts on YouTube at youtube.com/Doug McHoney. On this week's episode of Cross-Border Tax Talks, we're at PwC's Global Tax Symposium Europe 2022 in Barcelona, Spain, where I'm excited to be joined by Mario Alberto Gutierez. Mario is an international tax partner with PwC in Mexico City and leader of the International Tax Services practice in Mexico. Mario, welcome to the podcast.
Thank you so much, Doug. Happy to be here.
We've been talking about doing this for a long time, and we ended up having to come to Europe for us to do a podcast on Mexico.
It happens. It happens sometimes. That it's going to happen when it's going to happen, so don't worry.
Great. So before we dive into some of the substantive material, and there's been a lot of activity that's taken place in Mexico, so we're long due for this podcast, but I took 2 years of Spanish in high school. I've been down to visit you a number of times in Mexico City. You know my Spanish isn't great. I can order a cerveza. I can find where the bathroom is. What I want to know is, as a native Spanish speaker here in Barcelona, in Catalan, how do you do here with the language in Barcelona?
Well, to start, it's the Spanish in Spain, it's Castilian. So we already start with some differences in there. But then, talking about specifically Barcelona, I mean, it's Catalan. So I think it's as complex for me as it is with Portuguese. I hear them, I think I understand them, but then I realize that I'm totally lost. Okay. And the problem is that they can understand my Spanish. So I feel like in disadvantage there. I prefer to be a little bit more quiet when I'm on the streets, but yeah, it's interesting that you think that because they're kind of come from the same roots, right, you will understand a little bit of it. But no, I just realized that my Portuguese and my Catalan, I probably just leave it for home.
All right. I'm not sure. I don't think I could order a beer or find the bathroom in Portuguese or in Catalan. So, all right. Well, good to know. So let's talk about some Mexican tax developments. There's a lot that has occurred in recently. And I wanted to start with the implementation of the multilateral instrument. Yeah. Mario, I'll be honest, I think we talked about this on the podcast like 3 or 4 years ago. I think it was 2018. To remind listeners, it's 2022. Mexico is now officially adopted the MLI, right, I believe, although there may be some more procedural stuff. How did we get here, Mario? Yeah. And then we'll kind of dive into to what some of these rules mean.
And it's what I call the wolf is coming. The wolf is coming, the wolf is here now.
All right.
We have to be prepared for that. So a little bit of history on that is just, as you're saying, 2017, 2018, pretty much when this instrument was made public and all the countries started to adhere to it, Mexico did the same. I mean, we announced that we were going to be part of it and that we were going to be, adopting this model, this instrument. We have evidence that, this document was passed to the Congress, specifically to the Senate in 2018, but it was only after 4 years that they decided to start discussing it within the chamber and then pass it for ratification at the level of the Senate. So that happened last month. So now the process, this is the part that is a little bit different from other processes. So it's been ratified by the Congress, by the Senate in Mexico.
Okay.
Now it has to go through a process that is called the deposit. So they have to send it to the OECD and it has to be considered deposited. Once that happens, there's a 3-month period that has to pass before it's in force.
Okay.
And then we have to go and see what's the option that Mexico selected to be applicable. And Mexico went for the option that it will start the January 1st of the following year. So thinking with all these elements, the date that we think is going to start be fully enforceable, applicable, and kind of the deadline that we have, if you will, it's January 1st, 2024.
Okay.
So it's strange for us that so far the government hasn't sent for deposit this instrument to the OECD, but generally speaking, they have from today and until September 2023 to send it to the OECD. Then the 3 months that they have to pass, October, November, December 2023, and it will be enforced January 1st, 2024. So that's why we're thinking that's going to be the date that is going to be more relevant for starting following this rule.
Right.
And I guess another way to say it, or another way to put it is, probably we're going to have at least 1 year of a window of opportunity to review the implications of this instrument.
And get ready.
Get ready to it and see if there's anything that needs to be done. I wouldn't necessarily say just tweaks, but probably in some cases some big amendments to the structure that probably we have, just to make sure we're in compliance going forward.
Yeah, how many treaties does Mexico have?
We have 60 treaties. Out of those 60, 56 are what they are going to be considered as treaties covered by this multilateral, by the MLI. The 4 ones that are not in there, one is US.
Right.
It's not
That's
part
a big
of the MLI.
one. Yeah.
The other one is Brazil, that it's still not OECD, but they have mentioned their intention to convert into OECD. And the other, for instance, is Germany. That the interesting point with Germany is that they are not covered right now by the multilateral instrument, with Mexico in particular, but they have sent a protocol to amend the current treaty between Mexico and Germany, and the pieces or the articles that they want to amend basically want to include all these BEPS rules into the treaty. So I think they were betting on who's going to approve it first, either Mexican Congress to get the MLI, or in the particular the discussion that they're having, the negotiation that they're having for this additional protocol of the treaty.
Got it. So for many U.S. multinationals, obviously they haven't signed up for the multilateral instrument, and then it sounds like there are some sort of technical issues with the treaty from a German perspective, but it is not uncommon for companies to invest in Mexico through a holding company that you already have a treaty network with. So what are some things that the taxpayers and advisors should be mindful of as they're looking at structures? And I think really, presumably, the treaty abuse is probably the biggest issue that companies need to keep an eye on.
That's correct. And let me give you a couple of examples. And maybe just to start, I would say, let's remember that most of these structures were put in place when the tax frame was different to the one that we have today. There were different rules, different way to approach some of those tax implications.
Sure.
So I would say it's a different world, the one that we used to have in the past to the one that we're living today.
I certainly agree with that.
And with that in mind, the typical structures that we believe tax authorities are going to start looking at, for instance, as you were saying, holding company in country A that has a subsidiary, a subholding in country B, and then that subsidiary is the one that holds the Mexican shares. What tax authorities, we believe, are going to be interesting to understand is, why is that country B entity interposed between country A and Mexico? And if the answer is because the tax treatment maybe on dividends or capital gains is better by having that country B in between the structure, then that's where all these anti-abuse and kind of to try to avoid the treaty shopping rules will kick in. What we think that tax authorities are going to start asking, especially with the principal purpose test, is that they're going to start asking things like, okay, why you have that structure? What are the non-tax reasons to have that structure? And in the particular case of Mexico, we know that the tax authorities typically don't stop there. Typically, they go a little bit more beyond that part, and what they will request is documentation.
Sure.
So when I think about this, the typical document that comes to my mind, the first document that I visualize is the slide deck where all the tax implications are included in there. That's the document that we don't want to share with the tax authorities. Not because it's wrong, but it has all the tax analysis, and what tax authorities want to see is what are those other analyses from a business perspective, from a investment protection perspective. All those other things that were analyzed to get to that conclusion.
Right. Yeah, from my experience, working on these types of structures, the withholding tax implications are a factor in determining what is the appropriate holding company. Correct. Obviously, the substance and the investment vehicle and financing. I mean, there's a whole number of different issues. And I think, this is something that we've struggled with, obviously not just with Mexico, but applying the multilateral instrument. And it's going to be interesting to see how taxing authorities kind of look at this. But, as an advisor and as a taxpayer who is working on, let's say, doing a big investment in Mexico, whether it's an acquisition or maybe you're just doing organic growth and forming a Mexican subsidiary, well, who that investor is, there are a number of different factors that would apply.
Correct.
You would be incompetent as a tax advisor to not contemplate withholding taxes as one of the factors in determining what the appropriate jurisdiction is. And I think what's really challenging for both advisors and taxpayers is that, well, if withholding tax was one of the factors, does that violate this principal purpose test? And I think it makes it very challenging for advisors and taxpayers. Now, if withholding tax was the only reason that you'd set up the holding company, I think that's much more within the crosshairs of the multilateral instrument. But I think the lesson is it's important for taxpayers to kind of understand, and particularly for some of these structures that have been in place for many years, to go back and look at that documentation, whether it's the initial slide deck or subsequent decks, to really think about a principal purpose test, and knowing that it is a very vague standard and potentially gives the taxing authorities some ammo to come after these structures.
Yeah, and I totally agree with you. And I think that, again, when we think from the Mexican perspective, an additional item would be, okay, it's one of the many factors, and I hear that. It's not the only one, so that's good. You have many other factors. Where would you put in that list?
Yeah, how do you rank order them?
Exactly. I mean, is it the most relevant one, or how many factors do you really need to consider before saying, no, this is not one of the main ones, the tax implication. So yeah, that's going to be the complexity in that one.
Another gray area, and we've seen this in other jurisdictions as well, just challenging again for both taxpayers and advisors. One of the other, issues within the multilateral instrument is related to transparency. Why don't you tell us a little bit about that?
And regarding transparency and arbitration, what I can say is that historically Mexico has not followed any of those alternatives. On one end, regarding transparency, tax authorities in Mexico, they don't see it. I mean, they don't respect it. They actually amended the laws in 2020 to say, if you have a transparent entity either above or below a Mexican company or a Mexican individual, you have to look at it, and we have very particular rules for that. So transparency is definitely out of the picture. With the U.S.
So when there's a payment, for example, just to make sure I understand, so when there's a payment to an entity that would otherwise be transparent for the investor jurisdiction of that transparent entity, the rules do not allow you to kind of look through that to the investing jurisdiction into the transparent entity. You actually look at that effectively, I guess, nowhere entity.
Exactly, and that's a problem, because when you have to look at it and you see that it's a company that is basically not paying taxes because of the transparency that they are using, pretty much the answer for Mexico will be, okay, you're making a payment, or you're entering into a transaction with a tax-haven jurisdiction. So that's the problem with that.
Right. And to your point, oftentimes we'll invest in a transparent entity, but it's the partners, for example, in a partnership still may be paying tax on that. Exactly. But Mexico won't look through and say, this is still subject to tax. It's just, nope, it's a transparent entity. So just another trap for taxpayers and advisors to be mindful of.
Exactly. And with arbitration, the thing is that Mexico doesn't feel very comfortable, putting these type of discussions on third-party hands. So, they also opted better not to go for any of the possibilities for arbitration. It's, a little bit of a shame, because it would be great to be able to involve, or to have a different tool to try to get to some common ground, to some negotiations, but, it's out of the table now.
Okay. All right, so let's move away from the multilateral instrument. I want to come to the 2022 Tax Act. And so it's the end of 2022 here, so it's been a busy year in Mexico. The first question I wanted to ask you, and I find this more fascinating just as a U.S. advisor and somebody who advises a lot on Subchapter C and mergers and acquisitions, particularly share transfers, is that Mexico has now implemented a business purpose requirement for share transfers. Tell us a little bit about those rules and kind of how that changes the game for 2022.
And it really is changing, the way that we are approaching those type of transactions. The thing is, in the past, the requirement was, and the way that I always think of it is, okay, if you are a foreigner and you want to dispose of Mexican shares, you pay me 25% on the gross proceeds, and let's forget about it. I feel comfortable with that amount, and you can walk away. If you want to pay less, then appoint someone in Mexico. So as a tax authority, I can go and knock on the door of this person in Mexico or this company in Mexico and ask for more information and get more comfortable that the taxes were determined properly. So that continues to be the rule. The thing that they added is that now that person that you can appoint in Mexico to be the legal representative has to satisfy certain specific requirements. And we've been calling this now it has to be like a rich legal representative in Mexico. And by rich, what we mean is one of the new requirements is that this individual or this company has enough assets to cover any tax liability that is determined by the tax authorities. Remember that the legal representative in Mexico becomes joint liable for any taxation of the foreign company. And one of the requirements, I think it's okay, for tax authorities to ensure that the person is going to have assets or a way to face any payment or any liability in case they review it.
Got it. So this is for when you're doing let's say a third-party disposition. I assume would also apply if you're doing a related party transaction for consideration.
Internal as well.
But really relates to the non-resident capital gains tax in Mexico, which obviously we don't have in the U.S. So I always have to get my head back into this. And so this really relates to when that non-resident is disposing of those shares.
Exactly.
The general rule is that you would normally be subject to 25% taxes on the gross proceeds.
That sounds expensive.
Yeah, absolutely. And so if you can get an appropriate representation involved, then explain to me how that works, how you get to effectively a net basis taxation.
That's what you get. You should be able to get to a net basis, 35% on the net gain, which typically represents that you can use your tax basis, and that reduces the tax base in Mexico, and therefore you end up paying less. So the logic, the typical mechanic is 25% on gross is much more expensive than 35 on that. But to do that appointment now, this legal representative, this person that is going to be acting on behalf of the foreign company, has to have enough assets to face any liability from the tax authority. So if they come and say, I don't agree with your calculation, I think you should have paid more, they will go with this individual or this company in Mexico and say, now you are joint liable with the foreigner, pay me these taxes.
So I got it. So it really becomes a mechanism for collection of that tax, because if not, it becomes very difficult for the Mexican authorities to go after some non-resident to be able to collect the tax. Presumably, if it's the target that's being sold in Mexico, presumably they have the appropriate assets. So you just need to make sure that you identify that person from the Mexican target, and that business has the appropriate assets to support the sale.
The thing is that it doesn't stop there. There's one additional change, because that, in a way, we already had it.
Okay.
The additional change is now, for instance, one of the requirements is that the equity, if it's a company that you appointed in Mexico, that the equity of this company, the liability or the possible liability is no higher than 10% of the total equity of the company.
I see.
So let's say, that, to put a very simple example, if we say that the liability could be $10, this company has to have at least $100 as equity. So if you add as many zeros as you want to those numbers, we're saying that maybe the taxation is going to be $10 million, then you need, a really big amount of equity in the Mexican company to be able to act as the legal representative of this foreign company. That's where we are seeing that it's not easy to satisfy that requirement. Actually, from our perspective, it really gives us some thought about, is this rule trying to avoid the use of the treaties of course, tax authorities are going to say no, but we can't help but thinking that this is some sort of way to limit.
I see a mechanism to be able to get after that underlying base. Very
there can be, of
interesting.
course, a lot of critics around that idea. That
Sure.
Whether it's valid or not. We don't follow the same rules like in the U.S., where the latest rule is the one that you apply.
Yeah,
we kind of follow
pretty
more.
unique, I think, in the U.S.
We follow more like OECD and pacta sunt servanda
Right.
things, where we should respect the agreement that was that was concluded when this was negotiated.
Got it.
And with these changes, again, you can't help but think that this is in a way avoiding or limiting the use of those treaties.
Okay. So the other, I think, big change from the 2022 Act related to Maquiladoras and the ability to be able to get APAs.
Yeah.
So tell us a little about that.
Yeah, and that's unfortunately as well for the Maquiladoras. As you know, many years ago we used to have, and when I say many, to be honest, it's not that many, but we used to have like at least 3 methodologies to determine what would be, or what would be considered as an arm's length transaction for Maquiladoras. Now they have been eliminating some of those alternatives, where basically right now for 2022 going forward, we only have the safe harbor rule. It's either 6.9 or it's either on the assets or on the expenses of the company, 6.9 or 6.8 on that part. But the point is that they are limiting the possibility to use this type of...
Yeah, there used to be more flexibility. And to remind listeners that the Maquiladora is generally a structure for Mexican manufacturing where the principal or the investing jurisdiction is deemed to own the assets, the
Correct.
manufacturing assets,
Everything.
the raw materials, the inventory, and effectively Mexico is taxed as a toller.
Exactly.
And so, historically, you've been able to do advanced pricing agreements, work with the Mexican government to determine what the appropriate return should be related to that kind of toll. I call it a tolling return because it's very similar to a toll manufacturer. And so I think as a result now of the 2022 Act, companies are just, you just have to deal with the safe harbor.
Exactly. And there's one of the strategies that some of the companies followed before the fiscal year ended last year was to file for an APA. But they hadn't received any reply right now, so they are facing right now the decision, okay, what if the fiscal year ends, our fiscal year ends in December 31st, so what if the fiscal year ends and I'm still not getting that confirmation from the tax authorities? Do I have to kind of go back and amend the whole year? Can I still wait? And the implications that this is going to have as well in the accounting side, whether I have to record something as a UTP or something like that. So it's a problem we are facing now with the Maquiladoras, and unfortunately we don't have the entire rules right now that will give us more clarity, how to follow on that one.
Okay. Well, we'll stay tuned for those. Along those lines with the Maquiladora, because I think it's been a very effective regime that Mexico has implemented. I mean, it's been around for decades, right? Yeah. To be able to attract particularly manufacturing investment into Mexico. With all the supply chain disruption that we've seen, and what we refer to often in the U.S. is nearshoring, right? So U.S. multinationals, and frankly not even just U.S. multinationals, non-U.S. multinationals that are looking to have manufacturing closer to their customers, so really anybody serving the U.S. Just more from a macro perspective, have you seen significant additional investment and kind of more clients and taxpayers interested in the Maquila regime, or maybe if they're not even interested in the Maquila regime, if they're serving the Mexico market, looking for Mexican manufacturing?
Not yet, but at least, for instance, I was just reading on the newspapers the other day that the Mexican Ministry of Economy, according to their intel, they expect at least 400 U.S. companies to probably move their presence, their plants from Asia to Mexico. And at the same time, we are hearing, or we're seeing the interest of Asian countries to start having a footprint in Mexico and kind of get closer to the U.S.
Yeah, to their market.
So,
yeah, I think that's fascinating, and that's consistent with what I've read. And I think there's this perception of, oh, well, nearshoring is happening, and I think the answer is this just takes a long time, right? Like you just don't move manufacturing that has been set up many years ago.
Correct.
And I think that as a trend, and we've talked a lot about transformation and business transformations here on the Cross Border Tax Talks podcast, that it's like stay tuned, and I think the Mexican government is doing the same, as well as advisors of, we will see kind of more the nearshoring and trying to get closer to markets.
And that was going to be very interesting because, again, as you're saying, it's just the movement itself of those plans, of those investments, but everything that is around it. I mean, I see the infrastructure, the labor force, all those other things that can be triggered by this type of investments. That's going to be very interesting. So as you're saying, we're going to have to wait and see a little bit, but I think at the same time we're going to have to prepare and start thinking, how those models are going to impact and how they can be implemented in Mexico, as you're saying, from a custom, VAT, income, Maquiladora perspective, all those kind of things.
And we're going to add Pillar 2 to that list, but hang on here, because I can't not talk about Pillar 2 on these podcasts. But before we get there, I wanted to talk about debt structures into Mexico. And so I've been working with you on this for years. And for companies that use related party debt to finance Mexico. So very common, right? If a U.S. multinational is investing into Mexico, they will capitalize that Mexican entity with some combination of debt and equity. And if you lend in U.S. dollars, which has historically been more stable, right, you have to deal with this thing called the inflation adjustment in Mexico. So remind listeners, and particularly because the U.S. dollar has strengthened so much, and I just did a podcast with Rebecca Lee a few podcasts ago on U.S. foreign currency issues and frankly opportunities for taxpayers given a strong U.S. dollar. But maybe remind folks, particularly for taxpayers that do have related party debt, what is the inflation adjustment and why is it so important, particularly for non-peso denominated debt?
Sure. No, and it's a very important point. Of course, for us Mexicans that we have lived all our lives, surrounded and facing the inflation, it's we're used to it.
Right.
But yes, for people who's not used to these inflationary times, it's kind of a new thing. And it's something that probably they have suffered, let me put in those terms, in the past, but now with the rates of inflation that we're seeing, you can feel that impact even more significantly, more severe. So basically, this inflation adjustment means that I kind of see it a little bit more from an economic perspective, where if you lend me money, you're having like a cost of opportunity, meaning that with that money, probably you can go and buy some stuff, and it will, cost you a certain amount. Of course, you're going to be receiving the interest from the loan that you're giving to me. I'm going to be paying you interest, and that's going to be your profit, if you will. But the fact that you are not going to be able to use that money to get those goods at a certain price, but probably just in the future, when you receive the payment of the principal that I'm going to give you, you're going to go and try to get those goods, but probably now they're going to be more expensive. That, from an economic perspective, what it basically means is that you're having a loss. So that means that someone is having a win on that. From a tax perspective,
so it treats almost the borrowing Mexican subsidiary as the winner, if you will, which then requires some sort of imputation of income on top of the interest deduction that you would otherwise take.
Exactly. So that translated to the tax arena, what it means is that because I'm being leveraged by a loan from any party, I'm gonna have to calculate a phantom income from this loan that I'm receiving. So basically, it's the inflation that it's what is going to be added. It's what is going to be considered as this additional revenue. So why it's so important? Because the way that I think of it, and let me kind of give the takeaway first, is you have to crunch the numbers and put the model to understand better, what's going to be your position when you start asking or start receiving some loans from abroad, or even within Mexico. The point is, if you don't do that mathematic, what could happen is that the logic that you expect to have a deduction because of paying interest could turn into actually an additional revenue because of this inclusion of the inflation. So just to give you a very quick example, if the inflation in Mexico, let's say it's 8%, and your interest rate is 10%, that just means that you have a net effect of deduction of 10 versus revenue of 8 you have a net of 2, which probably is not that attractive anymore. And then if on top of that you add like the withholding, the foreign exchange, some limitation for TINCAP, for EBITDA, all those other rules that
layering
we have,
in all those other rules.
then, it's not unlikely that if you don't do all this analysis, you can end up with additional revenue than rather just the deduction that you were thinking that you will have in the beginning. So,
right. And obviously the interest with the higher interest rate environment, maybe that helps too, but also we're at a higher inflationary adjustment. And I think if there's one thing that you've taught me over the years is you got to do the math. And then you obviously have to keep up with the math on an annual basis. And I think that it's just very important for listeners to understand that it is possible that that can go upside down. In other words, that the inflation adjustment ends up being more than the interest deduction. Correct. And so in that case, taxpayers may be much better advised just to invest in equity. Correct. From the U.S., for example. The U.S. is just an example. It's really any foreign, it's any non-Mexican investment. But they may be better advised to actually just invest in equity as opposed through a combination of debt and equity.
That's correct. That's important.
So really important point on the inflation adjustment. So let's move then to here kind of the home stretch to Pillar 2. Have spent a lot of time here on the Cross-Border Tax Talks talking about Pillar 2, particularly with Europe and the fact that the U.S. is not going to be implementing their version of Pillar 2, particularly now with the divided government in the last couple of years here with the Biden administration. But what are you hearing in Mexico from a Pillar 2 perspective? And I feel like generally kind of south of the border of the U.S. and Mexico, Central America, and even South America, things have been pretty quiet. I know we've had 137 countries that signed on to the Pillar 2, but I feel like it's been pretty quiet. So what's going on in Mexico?
Yeah, and unfortunately, you're saying, we have heard a little bit about it, not official positions, maybe, a little bit, if you will, more like rumors or, kind of personal point of views.
Sure.
But
no formal pronouncements by the Mexican government.
Not at all. And basically, it's a little bit more like wait and see. They're kind of expecting to see how this develops. And I think the general perspective is because our current corporate income tax rate is 30%, we kind of see ourselves as one of those jurisdictions that is going to be far from the 15% global rate that it's being currently discussed for this Pillar 2. So that's kind of the starting point. Then from multinational companies like having investment around the world, we have some. I don't think as many as probably in the States or other jurisdictions. We have a few.
As far as the Mexican parented companies that have at least 750 million euro of revenue that could be subject to Pillar 2, even if Mexico doesn't adopt like the U.S. in the various jurisdictions in which they operate.
And even if in those cases where they could probably pass that threshold, again, we have some CFC rules, very particular CFC rules, not as complex as the one that you have in the States, but definitely
fortunately for you.
But definitely something to follow in there that, again, at least what we're hearing is there's no intention of the government to change or modify those rules to try to be compatible with the Pillar 2. So for now, I think we are on the safe side. We don't think there's going to be any significant movement or discussion around this Pillar 2 probably for the next couple of years, but we'll see how this develops.
Yeah, one of the things that I've given some thought to, and I know we've chatted a little about, is with respect to the Maquiladora regimes that we talked to a little bit earlier. And effectively what that allows taxpayers to do, again, is to treat the Mexican subsidiary as a toll manufacturer and that the foreign investor and the principal company. So one of the questions that I have is that the model rules and commentary generally require, for purpose of determining your globe income, that taxpayers are operating from an arm's length perspective. And so the question that I don't think there's an answer to, but is there risk, and probably something that the Mexican policymakers should be thinking about, is there risk that the income associated with the maquila is viewed as below arm's length or less than arm's length, such that additional income could be attributed from whatever the principal jurisdiction is down to Mexico, and then that could certainly cause Mexico to be diluted well below the 30% statutory rate.
Correct. No, I totally agree with you. As you said, it's something that we're giving it some thought, we're analyzing. I really think that due to the mechanics that has to be followed, that could definitely follow into that category. That could definitely be something that we will have to analyze and kind of continue seeing how this develops. But yes, there's definitely a possibility, at least right now, a theoretical possibility that could be the case, that this particular regime is seen as sort of an incentive that would be through the adjustments from a transfer pricing perspective, that they will probably put you in that position to have to consider some additional revenue, some inclusion for this pillar too. So
yeah, and then it begs the question of, does it make sense to do a qualified domestic minimum tax, or like other jurisdictions, do you rethink these types of incentive regimes?
Yeah.
Lots of questions that are applicable not just to Mexico, the U.S., and frankly any other kind of global, anybody operating globally now with multinational.
Correct.
All right, Mario. Well, this is a fascinating discussion, a good flyby on Mexican taxation. Thank you very much. Informative as always, and it's great to finally have you on the Cross-Border Tax Talks.
Perfect. Thanks so much, Doug.
Thank you. So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Mario Alberto Gutierez, PwC Mexico's International Tax Services Leader. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned in 2 weeks for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.